Hello. Bank and financial institutions, before the global financial crisis of 2008-9, were able to operate really without much regulation on what they did. There were minimal requirements for how much capital they kept in reserve in case there was a default by their loans or a general systemic crisis. And what they did, bought, sold, and said to customers around the world was really not regulated at all. Indeed, it was called light touch regulation. So governments really left banks and financial institutions to get on with it. Such was the result of reckless greed, of fraud, of criminal conspiracies, of tax evasion, of money laundering, which eventually led up to the global financial crisis of 2008-9, plunging the world into a global economic recession. Since the end of that global economic recession, international agencies like the IMF and others say, yes, they're going to sort out the problem of banks so this never happens again by introducing tougher regulation, more conditions on what banks have to do. And the same applies from national governments who've spent a lot of time talking about this. But the reality is, just over 10 years later, really nothing much has changed. The scandals, the conspiracies, the fraud has continued in the banking and financial sector without relent, really. It's an unending story from the banking folk of the world that they continue to operate in a completely both illegal way on many occasions, but also in a way which is not in the interests of society and the public at large. And governments and international agencies are really doing little about it, and the regulation that they have is just not working. I want to present in this short YouTube session why regulation is not working, why they fail to control the banks, and what we need to do about it. We cannot go on like this. Let me talk you through some of the things that the banks have been doing both before and after the Great Recession. Jim Chanos is a leading hedge fund manager. He's always looking for a way to make big bucks out of bad decisions made by the banking and financial sector. In a recent interview, he said, the current environment, and we're talking about 2020, is a really fertile field for people to play fast and loose with the truth and for corporate wrongdoers to get away with it for a long time. Regulators, he said, could be much firmer in clamping down on metrics that are just increasingly unmooring themselves from reality. We have just only in the last month been exposed one of the biggest scams ever seen in the financial markets, and in a major bank, a German digital payments company called Wirecard, which has been forced into bankruptcy after admitting that nearly 2 billion euros of its cash did not exist. The chief executive, Marcus Brown, and other Wirecard executives have been arrested for fraud, from hiding from investors and the public that they really did not have the money to continue this operation. Now, the Securities and Markets Authority, the regulator, which oversees the financial system in the European Union, said it would now scrutinize what Germany's banking and accounting regulators are doing after Wirecard was exposed for this fraud. But of course, this is after the event. This has been known, dangers about Wirecard, for 5 years. Nothing has been done by the regulators, both internationally and in Germany. Then take another scandal, only reaching its conclusion at this month. Goldman Sachs has settled with Malaysian government for over nearly $4 billion because it arranged bond sales for what is called a Malaysian Development Bank, 1MDB, raising $6.5 billion, much of which was stolen, it seems, by the former Prime Minister of Malaysia and other people. And the Goldman Sachs seem to be involved or unable to stop this while receiving $600 million in fees. Malaysia has said that they need to repay that money and suffer a fine because of the way in which they connived with the former government to basically fleece the taxpayers of Malaysia and the possibilities for development there. The Goldman Sachs leader at the time, chief executive, was Lloyd Blankfein, who stands on the religious ethics. He says that Goldman Sachs operates on the basis of doing God's work. Well, Malaysian government filed charges against 17 and former executives of 3 Goldman Sachs subsidiaries over this scandal with the former Prime Minister of Malaysia. And if that's God's work, then it seems that devil has intervened in some way. Other banking executives who consider themselves doing God's work, take Stephen Green, former chairman of HSBC, when he was operating the private sector part of the bank, the private bank for wealth holders in Switzerland, he claimed he was doing God's work. He's actually written a book as an ordained vicar called Good Value and Ethics, Morality in an Uncertain World in Banking to promote corporate responsibility. Well, he was in charge of the private banking division in Switzerland, which is engaged in laundering for thousands of rich people in many countries who do not want to pay tax for various schemes. HSBC was eventually fined also $5 billion by the US federal authorities for laundering money for Mexican drug cartels. That's again doing God's work. Over in Switzerland, the chief executive under Green in the Swiss private bank of HSBC had to plead guilty to helping hide assets worth 1.6 billion euros. Peter Braunwalder was fined €500,000 euros personally and given a 1-year suspended jail sentence by a Paris court. He admitted he'd been helping clients to evade taxes just before the Great Recession by opening a special bank accounts and setting up offshore trusts, straightforward criminal conspiracy. He did not end up in jail. The Swiss bank UBS has also been doing the same sort of thing, recording a €4.5 billion fine for criminal wrongdoings of an exceptionally serious nature, so the authorities. And all the bank executives again avoided prison sentence. French bank Société Générale was ordered to pay 250 million euros in end a bribery case where French fund manager Carmignac Gestion said it would pay 30 million euros to settle a tax fraud case. And so it goes on. Perhaps one of the biggest scandals of all was the position of the supposedly good bank, Danske Bank in Denmark. Danske Bank has provided us with the largest example of a modern banking irregularity. Over $235 billion in special transactions flowed through the tiny Estonian branch of that bank in order to money launder ill-gotten gains from Russian oligarchs, criminals, and various other rich people around the world trying to avoid tax. Just 4 years, they managed to push that through the small Estonian bank. Going further back before the Great Recession, take RBS, Britain's largest bank, partially nationalised in the crash. It was run up to then by Fred Goodwin, Fred the Shred, so named for his penchant for slashing lower-ranked banking jobs and bank branches. He was knighted for his services to the banking industry by the then Labour government. But he was noted in particular for his risky ventures and huge bonuses. He drove RBS into bankruptcy when he took over the Dutch bank without really having the funds to do so, without any profits being involved. He took a fat pension and handshakes from the RBS board when he was sacked, as of all the senior executives of the bank who have been asked to step down following a scandal. And then we had, in the period after the Great Recession, the great interest rate cartel rigging scandal. Interbank lending. Interest rates are supposed to be on a competitive basis between banks offering different interest rates, particularly in the wholesale market, and that sets a LIBOR rate, the London interbank rate, in order for deciding the base floor for loan costs. That is the interest rate that local authorities, charities, and other businesses need when they borrow money. That's what they're going to pay. But it appeared that all the banks, including RBS, under the watchful eye of Stephen Heston, who was appointed when the bank was nationalised, for 2 years, LIBOR traders in various banks, including RBS, carried out a close rigging monopoly rate in order to keep the rate up and make more money out of its customers. Banks continue to operate in this entirely conspiratorial manner to make funds. The biggest scandal again in the UK was mis-selling hundreds of thousands of customers personal injury insurance that they didn't need to the tune of £5 billion over a period of time. Added to whatever their loans were, they had this injury insurance added so that the banks could make commissions and interest on that. This scandal was eventually reversed by the regulators, and now banks have been having to pay that back. During the crash, Barclays Bank, run by Bob Diamond at the time, was going to be nationalised. So Barclays Bank loaned money to Qatar, and the Qataris then invested in the stock of the bank to the tune of £12 billion so that the bank did not need to become nationalised. But it did so by giving loans to the Qataris. So it was a circular process, and the commissions paid to Qatari investors to take these very nice loans and then reinvest them back into the bank have never been revealed. And yet Bob Diamond admitted that Barclays' actions did not meet the high standards that we set for ourselves. As he said, a bank's culture is how people behave when no one is watching. And that is certainly the case in most banks. Remember the Panama Papers? Revealed by journalists that major heads of state in all sorts of countries, government officials and close associates of heads of government were engaged in laundering the ill-gotten gains that they made by various methods, either through tax evasion, fraud or drug trafficking. They did that through shell companies offshore, in particular Panama. Panama has been picked out because, as the Europol's Financial Intelligence Group said, that these shell companies play an important role in large-scale money laundering activities, but in fact it was Panama that was exposed by journalists finding out these accounts and these companies. The Tax Justice Network says that the oldest and best known tax havens are in the Americas and in Latin America, but also they're getting money from all over the world and elsewhere. And the banks are organized to provide this service in getting these shell companies set up. As John Horan, Senior Associate at the Mays Investigation and Compliance Training Centre in Belfast, says money laundering is a Europe-wide problem. Dark money will almost certainly continue to flow through the European banking system like sand through a sieve. And you can see this process of moving this money around through various accounts and various banks could only work unless the banking system and the financial sector was involved in a big way. And the tax haven scandal, which we have internationally, where large amounts of tax now, something like 12 to 15% of tax, even 20% in the case of the US, of corporate profits, US corporate profits, 20% of that is hidden in tax havens. That can only be done and organized and transacted by the banks. Half of all foreign profits now are booked in tax havens, with Ireland, of all that money that's going abroad, Ireland has 50% of it, with the tax rate just at 5.7%. And the benefits for the increase in profits then go to the shareholders, basically stealing from taxpayers. The biggest case of that, of course, was Apple. Apple has piled all its European profits into Apple Sales International in Ireland, where there's hardly any Apple operations at all. In there, well, what happens is all the sales that they've made in Europe, they then make that money, and the profits they're making are then deducted because Apple Sales International charges a management commission to the European subsidiaries, and that money therefore ends up in Apple sales, where the interest, where the tax on corporate profits in Apple sales is only less than half what would happen if it stayed in the stores in Europe. And then that money flows back into headquarters of the US or into various other tax havens. In Ireland, the Apple Sales International is just a head office existing on paper, and it hardly gets taxed at all. This forced the European Union Commission to consider forcing Ireland to get this tax back from Apple. Apple went to court and, as of now, has won their case, so that Ireland doesn't have to get this tax back for its own taxpayers. it's simply Apple can continue to keep this money. And so the money laundering, the tax evasion, the connivance of the banks in doing this continues unchecked. The light touch regulation that existed before the Great Recession has hardly changed at all. In 2004, the UK Labour Chancellor, Gordon Brown, opened Lehman Brothers' Canary Wharf office, a new building. Lehman Brothers, as we know, was the major victim, if you like, or the major culprit in the global financial crash of 2008-9. Back in 2004, Gordon Brown told us that Lehman Brothers is a great company that could look backwards with pride and look forwards with hope. Well, the result was the greed and the fraud and the reckless behavior of these banks with no regulation, a culture of light touch regulation enjoyed by all these banks, whether the governments were supposedly Labour or on the Conservative side, eventually led to that global financial crash. Has regulation been toughened up since? Not really. In the Global Financial Stability Report recently, the IMF claims that after a decade of the global financial crisis, much progress has been made in reforming the financial rulebook. And it's given that new standards with a more resilient financial system, one that is less leveraged, more liquid, and better supervised. Really? The evidence shows not. Take this example. The regulators have been useless in stopping these tax avoidance schemes. Carol Sargent was the regulator at the UK Financial Supervisory Authority and headed up the supervision of all the banks at the Bank of England. She got an honour for the Queen for services to financial regulation. She joined Lloyds Bank in 2010 and received bonuses, which now Lloyds are asking back, because she presided over the payment protection insurance scandal I talked about earlier, which Lloyds must now pay back 18 billion in compensation. So much for regulation there. And how does she work for now? Yes, as a non-executive director of Danske Bank, where the biggest scandal of money laundering of all has been revealed. And her responsibilities at Danske Bank? To make sure the bank operates under regulations. Nick Hatch-Shanson recently wrote a book called Treasure Islands, which he shows all the tax havens and other movements of money organized by the banks for their rich clients and for corporations around the world. It's a book that everybody should read. And then he's written more recently another book which shows that not only is the City of London and the UK financial sector operate to help tax avoidance and money laundering, it does not provide credit for productive investment. That's most important. All this money swirling around in the places is not being used to develop the economy, improve employment, improve productivity, improve technology. In other words, improve our prosperity. It's being used basically to service finance and the rich clients that it represents. But the question I would ask, after Shaxson shows us all this, the way in which the financial sector takes money out of creation of wealth, how it controls our laws and so on, how they operate in a corrupt way, creating inequality, distorting markets, spreading crime and so on, as he says. So what's his answer to this situation? Well, we need to tax, regulate, and police our financial sector more. So it's back to set the policies and the approach that was adopted before the global financial crash and is still being applied. Just regulation, but regulation does not work. This is what I want to argue here on this YouTube. Joseph Stiglitz, who is the Nobel Prize winner in economics in America, a tireless campaigner against finance sector. And he points out in his book, Free Fall, how the finance sector and the banking sector boosted the credit for mortgages and the housing market, leading to a huge bubble which ended up triggering a financial meltdown in 2008-9. And in his Stiglitz report to the UN, he declared, governments deluded by markets forget the lessons of both economic theory and historical experience to note that if the financial sector is to perform its critical role, there must be adequate regulation. So we're back to regulation, not control, not ownership, but regulation. What is Stiglitz's answer to this terrible situation amongst the banking and financial sectors? We must avoid future meltdowns by empowering incorruptible regulators who are very smart people. These very smart regulators should be employed from unions, non-governmental organizations and universities. Well, we're going back to the same position as before, where we have regulatory agencies employing these sorts of people trying to regulate what's going on in the banks. Of course, this has failed now for the last 20 years. Why should we think it would work now? In fact, in a book recently, two authors pointed out that if you look at what has happened with regulations in the 10 years up to the Great Recession, all the people who are regulating were exactly the people that Stiglitz talked about. There's nothing different there. They're just unable to really operate any sort of regulatory control over the banks and financial institutions. These particular authors want to return to no regulation at all because they say regulation fails completely. More recently, Edward Kane at the New Institute has argued that the banks are just not possible to regulate them properly. The regulators are too weak. They are too easily confused or connive with the big banks to re-establish all what the banks want to do and raise their leverage to dangerous levels. Top regulators seem to believe that an important part of their job is to convince taxpayers that the next crash can be contained within the financial sector and won't be allowed to hurt ordinary people in the ways that previous crises have. But, Kane says, these rosy claims are bullshit. He wants to lock bankers up, but that's after the event. How do we stop banks doing all this before it happens anyway? Nothing has changed. Big salaries for pensions for executives, overseas tax scams, fraud and corruption. And now a real and rising instability and collapse in the pandemic because of the increase in loans and so on and other fictitious activity on the part of the banks could lead to a new financial crash. Here is a graph on the right-hand side which shows the increase in the leverage that banks have had since the end of the Great Recession. You can see that it's risen back to high levels. There's a lot of borrowing by commercial and industrial companies around the world, and the banks have got a lot of loans out there in the market, hoping that they will not lead to a collapse and defaults. In fact, banks are now having to look at something like $60 billion in case there are defaults in the next year or so during this pandemic or in its aftermath. International banks may be better capitalized, but they still continue with all the same old policy that they've had before, and systemic risks, according to the IMF, with new forms of shadow banking and market-based finance outside even the regulatory perimeter as it is now, means that there could be renewed trouble for the banks and the finance sector in general. Andy Haldane, the former Bank of England chief economist, has pointed out that finance really is socially unproductive. In what sense, says Haldane, is increased risk-taking by the banks a value-added service for the economy at large? He answers, in short, it is not. So the banking and financial system is operating in a criminal, corrupt, illegal, or in many cases, irregular and reckless way. And at the same time, what it's doing is not actually improving the conditions in the real economy, as it's called, for people, workers, and for productive activities in the economy as a whole. It is a waste, a misallocation, and a generally negative result for economies around the world. In my view, and it's the view apparently of a minority, it's time for proper public ownership of the banks, the big banks in America, in Europe, and in the UK and elsewhere. Without public ownership and control of those banks, we can't begin to stop this process of corruption, tax evasion, and so on. It will continue under so-called regulation unless the public as a whole has direct and legal control of these banks and can change what their managements and their operations are doing. After all, banking should be a public service, should be a proper banking service to take our deposits, look after our savings, offer loans to households and small businesses at reasonable rates, instead of being an operation which it currently is, more interested in speculating in financial markets for big bucks, making corporate finance deals, helping rich evade payments, while top executives take home huge wages, bonuses, and pensions. It's time that banking was a public service internationally, social service, not a speculative system for capital. And there are some banks that do operate like that. There are small banks. Take the example of North Dakota. This bank is in a right-wing US state and has been publicly owned since the Great Depression. It looks after the deposits of its customers. It provides loans for households and farmers, and any profit it makes goes back to the state government. It does no speculation and no laundering, and it did not suffer during the global crash. If we had a democratic, publicly owned banking system in the major economies, we could begin to use the resources and the facilities and the services that banks can provide in a way that would really help the economy as a whole and society as a whole, and not just as a speculative operation and a criminal conspiracy for the very rich. It could be part of a national plan for investment involving all parts of institutions locally in any society. It could be publicly owned banks, could be combined with co-op banks and credit unions and other operations, and they will be controlled, in my view, not just by national government, but also by local associations, trade unions, and bank workers themselves, to end the big bonuses and the big paychecks and the big options, stock options for the top management and chief executives who make all these decisions that lead to disaster. It's time we returned to forget about regulation, bring in public ownership and democratic control of the levers of finance. I'll finish on this point. Lenin said the banks we know are part of modern life, the principal centers of the whole capitalist economic system, said Vladimir Lenin. To talk about regulating the economic life and yet evade the question of the nationalization of the banks means either betraying the most profound ignorance or deceiving the common people by florid words and grandiloquent promises with deliberate intention of not fulfilling these promises. That is the situation we are in the moment with regulation. It's time to recognize that regulation does not work and that we need public and social control through ownership and through democratic institutions of the banking and the finance sectors around the world to change things for good.